we define the baseline as putting in the basic data so that we're ready to do a as-is valuation of the company. So at this point, I've put in the income statement data, put in the balance sheet data, and put in the cash flow data on the assumption screen, updated the WACC, updated the shares outstanding, and then updated the forward sales and forward EBITDA consensus information, and then also updated the miscellaneous balance sheet data from the footnotes. So the other key part of the baseline, since we're using a reusable model, is that since we started out with most likely the Coca-Cola model, in the Coke model, we had put in some hard-coded growth numbers into the future, and we had put in some hard-coded EBITDA margins in the future. And so I want to make sure that I got rid of those. So easiest way to do that would have been to take for 2016 equal the previous year and copy that over. Because I might get some strange valuations. Matter of fact, I think it would have started out at like $300 a share if we left the Coke margins and Coke growth rates in, and we don't adjust those. So again, just having everything equaling to the original data from HP forwarded out, and then that would have given us a baseline price of around $64 a share. Now, when we did the assignment last week, 2 weeks ago, HP was trading around $34 a share. So from an as-is perspective, we needed to get to 34. Now, what's interesting is that if we go into HP and we look at go to the desktop here. If we look at the growth rates in IBIS world, bottom of the report, we see that revenue growth rate for computers is low single digits, 2 to 3%. And we see that for IT consulting, which is probably the majority of HP's business these days, it is expected again to be low to mid single digits, so a little bit more cyclical than the computer consulting and hardware business. Now, what's interesting about the consensus data for HP is that if we look at the consensus, the market's basically expecting them to be flat for the next several years. So HP is underperforming the market and most likely does not really have competitive advantage. So we're kind of seeing that in their struggles in the marketplace, probably in their valuation. So the question then becomes, from an as-is perspective, how do we get it closer to that $33 per share? Now, the other thing I'm going to do as we're talking here is load up Bloomberg. And when we look at the Bloomberg data, I want to kind of get a sense of, as we're doing the as-is valuation, what is the analyst consensus on HP and Hewlett Packard. No, I don't want to download Bloomberg again.
All right. Hey, can we all make sure that we mute our mics? I think we're getting some kind of music going on in the background, kind of hard to hear sometimes.
Yeah, somebody's got it sounds like a TV on in the background. There we go. Thank you, whoever muted that. Thanks for the request there. So one of the things that we'll probably want to check is the analyst consensus for Hewlett Packard. So I'll go to HP. And that would be under ANR for the analyst recommendations. Just to get a sense of where the analysts are in terms of their price targets. And what's interesting is many of their price targets are between low 30s and $40 a share. Again, right now they're at $34 a share. And most people are at the hold category. There's a few buys. There's kind of one sell in this marketplace. And again, what we're going to now do is focus on sort of the as-is valuation. So I guess the point here is that right now we're getting a share price of about 64. And as I said, if we go to the price we had 2 weeks ago when we were doing this, we were talking about 34 a share. So I guess the question is, how do we get to 34 a share? Well, basically, revenue growth is already pretty anemic because the next 2 years they're shrinking and they're going into a growing market, which means they're probably not going to see revenue falling off of a cliff. So I don't think that that's the reason why the market thinks that they're going to be $64 a share. As I said, if we look at both hardware and if we look at IT consulting services, we can see that basically those businesses are growing low single digits for the next 6 or 7 years. And that's probably not HP's real challenge. So it does suggest that the problem is either going to be in the margins or in the tax rate. So if we look here, right now our model is using a 16% tax rate because it's taking an average of the last 6 years. Except in 2012, HP got a tax refund. So that is probably distorting the average. And if I look at the other years, 20.5, 20.2, 21, 21 and a half, 19, I think that realistically a more realistic tax rate is going to be something probably closer to 21. So I'll adjust the tax rate to something I think is more realistic in the future. That gets me a little bit lower at 59 a share, but again, I still have to get to 34. So what it really suggests is that EBITDA margins, which 12.9 is where the consensus is, 12.8 and 12.9 for the next 2 years, probably is going to go down. So what I would say is, from an HP perspective, I'm actually going to increase their growth to about 2% a year because at some point I do expect them to grow with the marketplace. I mean, I think their CEO is probably not just going to stand by and cut costs the entire time. So the question really becomes then what happens to margins? So if I go here to our EBITDA margin, then I would say they were at 2013, they were 11.4%, and then 12% below that. Obviously, they've been improving some cost margins through some cost cuttings the last 2 years. But what if their EBITDA starts to go down again? And so in this case, if we go back down to where they were, 11.4, then we're back at $59 a share, which suggests also, by the way, if I have a 2% revenue growth, before I forget this, on my assumptions tab, I want to take my continuing value revenue growth down to 2% as well. So long term growing a little bit slower than the economy, which then suggests, again, I'm at 53 a share, suggests even lower margins than what they've experienced the last couple of years. So I'm going to go a couple years further out, drop that to 11. Drop that to 10 and a half. Drop that to 10. Actually, let's go back to 11 faster, 10 and a half. What am I trying to get to again? It's 34, I believe. Check that screen. Yeah, 34. So what's that? Let's go down to 10, 9, 8.5. I'm just stepping it down a little. 8, 7, something like that. And that gets me closer to 34. So really, what it appears in the as-is valuation, the market is saying for Hewlett Packard is that they're probably going to have severe pressure on their Ebitda margins, and Ebitda is going to fall much faster and further than what they had experienced previously during some very tough times for themselves. So the market is just forecasting a much more competitive market in a low growth scenario for HP. And if I look at my ROIC chart, basically what it's predicting is a true regression to the mean where they're getting much closer to their cost of capital. So I'll just pause here and just see if, as you guys were coming up with your as-is valuations, whether or not you were coming up with a similar scenario or had a different feeling about HP. So just opening up to anybody that's on the webinar for
Hi,
thoughts.
Professor.
Yes.
Hi, this is Joel. So I guess my assumptions were more radical,
Okay.
um, because I just assumed that they their revenue growth would be in the negative and even further negative.
Okay.
I did keep the tax rate at 21.5 because I did find that the 2012 tax rate was an outlier, and I had the Ebitda margins at 12.0%, just staying right there because I figured it would hover between maybe like 11.5 and maybe 12.5. So I figured I'd keep it at 12. But my revenue growth I had at negative 5.8%, and they gave me a price share of 33.85.
Okay. So
And I
go
just figured,
ahead.
okay. Now my reasoning for the drastic drop in revenue growth is, um, I feel that apart from the IT consulting, where they're them selling business products like Quick Test Pro or Quality Sun to like the other businesses, but they had a big consumer uh, business, and the trend nowadays is moving away from desktops and hardware to more mobile devices, and I don't think HP is a major player in that market. So I just figured that they would suffer from that.
And that's not an unreasonable assumption, especially when you use the word. I think the key word in your point of view is the consumer business. That the consumer PC business is doing very poorly. It's become very much a commoditized price business. The prices keep falling in that business. Unit shipments are not growing, and as you pointed out, they don't really have a presence in sort of the mobile devices. So it's not an unreasonable scenario that you could see a drop in revenue. So even though they're growing their IT consulting, their hardware business, and their printer business is probably suffering just as well. So that is not out of the bounds that could be happening to HP as well. So you could see, as you said, slightly higher margins than what I'm predicting and slightly lower revenue growth. So either of those two scenarios are a legitimate possibility. How about somebody else from the group? Anybody else had a feeling on this? Somebody else want to give their as is thoughts?
This is Sean. I was with Joel on this one. I thought
Sean,
that their
I was with Joel on this one. I thought that they're
short-term sales would be a little bit light, but their margins would remain strong. Just looking at their tree, it looked like they had a pretty consistent execution. Their SG&A costs started to climb, and I thought that would be a pretty easy thing for them to tackle as they moved from more of a hardware focus to more of a service industry.
Okay. So if we were to take that scenario in here, I'll go back to the ratios. So basically, when both of you were thinking that the margins were closer to 12, is that what you're saying, EBITDA?
Yeah, around 11.5, 11%.
Let's say 11.5. Oh, 11.5 down to 11. Okay. And so revenue growth continued negative. Is that what you were?
Yes.
No.
Yeah, I don't know what Joel had. I had it flattening out pretty much around.
You had it flattening out. So eventually going down.
I had it maxing out at 0.5%.
So it could be something, not 50.005. If they essentially flatline, and then same here, if we go back to our assumptions in our continuing value, make that 0.05%. 0.005%. There we go. Then if we flatline it and then basically maybe make the margins 11% a little bit sooner. Call that 10. Somewhere in that range. So again, seeing an EBITDA fall to about where it was in 2012. About where it was in 2013, in the next 2016, 2017 range, and then maybe a little bit below thereafter with flat growth somewhere in the middle. But I think what we've established is that at best, the market is looking for relatively flat growth, plus or minus a couple percent. And even in the worst case scenario of declining revenue, the market probably is still assuming some declining margins on HP, that they're not jettisoning their hardware business completely in the plan that the market must be looking at and focusing on services. So I don't think we're seeing the markets believing that HP is going to try some sort of IBM strategy where they get rid of all of their lower margin hardware and focus just on the service business. So I think that from an as-is valuation standpoint, they're just going to kind of plot along and optimize what they have. That's kind of the as-is scenario for the marketplace, which is probably why you're seeing, and we go back to Bloomberg, a lot of holds. So from a market perspective, this is the kind of plot along strategy. Flat growth, don't really see any improvement in margins, maybe a little bit of margin pressure. As you said, they're not really getting into the growth part of the hardware business. They really have no presence in the mobile market, although Meg Whitman has been suggesting that they're going to introduce mobile phones, or maybe they did and nobody bought them. I don't know. But basically, they're just kind of plodding along. And I guess that's where you get the hold strategy coming up by most of the analysts. So we'll call this our new as is. Save this. And then we have to figure out whether or not we agree with this. So is HP a buy?
Professor, a question about your CVG.
Yep. Go ahead.
What was your CVG again?
I moved it down to, well, in this scenario, we had said revenue growth. I tapered it down to about 0.5% growth on the positive side. So I made the CVG 0.5% as well. Because it wouldn't make sense to say that we think that they're going to grow about, 0.5% or 1% a year and then have the continuing value be 3%. So we just need to kind of test that in the future. But what we're really saying is that, HP is most likely not even growing at the rate of the economy. And in this case, they're not really even growing at the rate in the current scenario for the as is, the rate of the computer industry, which we saw in the IBIS World Report, was again in the low single digits. So we're just looking at sort of long-term true underperformance here is what's being priced into their stock price at the current point in time.
And can the CVG be negative?
It could. I mean, generally for most big companies, unless they're in declining industries, we probably don't want to make them be negative, but technically it could be negative. So we could have easily made this negative 1%. Is this an example? Although you'll notice that if you have negative growth here, that their stock price gets even lower. And so what you're saying is they have negative growth at a positive spread because their spread is still positive, and that will essentially erode value over time because they're not even getting the positive growth that we originally had projected in the early part of the model. But I'm going to make this, again, 0.5. Usually for most of the companies you're going to be evaluating, so like for a Pfizer or Merck, you're probably not going to have negative growth long term for those companies. You could probably just zero it out in your case if you think there's not going to be any long-term value. By the way, the other thing that we can check in our evaluations, and I'll go back to IBIS World, still hooked up here, or sorry, go back to the Smith Apps portal, is, where is it? Thomson 1. And this is something that may help you as you guys are doing your evaluations. So let's load Thomson 1 here. So again, I don't like Thomson 1's data. That's why we're using Bloomberg's data. But there is one useful feature in Thomson 1 for us, assuming it will load, which are the analyst reports. So if you load Thomson 1, and then up here, it's web-based platform, type in the company name or ticker symbol. In this case, I'll type in HPQ. Go to Hewlett Packard. Then there is depending on the size of your screen, there might be a more options, and then you can go to the more options. But basically, there's a research tab. And if you click on research, company research, this will show you the analyst reports available on Thomson 1. And again, they're in reverse chronological order. But, look for one of the bigger banks, and obviously the ratings. These are the analysts with higher stars that are generally tracking better. So in this case, this person from Barclays has done a better job. So again, I have a 20-page report from Barclays. Click on this, select all the reports, view it. It might say it costs you a certain amount of money, but as part of our license, these analyst reports are free. And this would be the detailed analyst report from Barclays on HP. So we'll save this, put this on my desktop, I'll upload this. HP Barclays. So this is a July 2nd report, and they talked about how this is a stabilization year, PC trends better than expected, etc. They actually are, I said they remain long, which means their recommendation here is neutral. Obviously, they're talking about the PC business. And down in here, you can actually see what their PC model is for growth. Notebook model. So basically it looks like they're just drawing from IDC. There's a hardware model. Talk about market share. But I guess the point is these analysts are doing some of the diligence as well that we would be thinking about. In this case, they seem to be focusing more on the hardware sales than the software sales of HP, but nonetheless, they're giving some data behind their recommendation. And we'll do one other quick one here. Let's do this guy from Deutsche Bank. So what I would recommend for your group projects is the same thing. Pull a couple analyst reports because they will help you as you're coming up with your own scenarios for the future. So HPDB is an example. So again, Deutsche Bank is a little bit bullish in HP. They have a $40 price target. And in their scenario, they're basically saying their R&D is not reflected. They think they're well positioned for the next phase of IT. And basically what they're saying is they're relatively cheap on a valuation basis. So Deutsche Bank is obviously a little bit more bullish on HP. And where they're probably driving this would be to go back to our other part of our assignment here. And if I look at the RV, and if I look at the multiples that we had done, select stats, market cap weighted average, and I use the Bloomberg peers. Hide the top section so it's a little bit easier to see. But the point is that HP is trading at a discount on most of the multiples, with the one exception of the PEG ratio. But basically, what Deutsche Bank seems to be arguing is back to regression to the mean. Is they're saying that HP is cheap on a multiple basis relative to its peers, and so therefore they think that there's just upside if they can just be considered an average firm. So what they're basically saying is if they can get average growth and they can get, margins that are not declining over time, then they're probably going to see slightly higher multiples, and that's their justification for a buy. So they're basically arguing that they're not going to get the revenue decline that we're predicting. They're probably not going to get the deterioration of margins that we're predicting in order to justify the current price. And the market is being too pessimistic on HP. And they're using multiples as another justification for that by saying that these multiples, which are trading at a discount, are not justifying HP at its current price. So that's probably how they're coming up with their buy scenario. But while we're on this screen, since we were also talking about the multiple analysis, what could we say about HP that justifies these lower multiples? So they're obviously trading at a discount, right? Particularly on enterprise value to sales, trading at about a third of the industry, lower EV to EBITDA, lower EV to EBIT, and a lower PE ratio. So why? What can we say about HP?
It's got a lower growth rate.
Yeah, 3.79%, which is obviously, if you look across the peers in this industry group, is the lowest in the industry. They have a lower growth rate, and then their PEG actually suggests that they have probably a reasonable ROIC, although their price to book says a lower than their peers' ROIC in some cases. But the interesting thing is they still have a positive spread, but it's really the low growth rate. And that is their challenge. So I guess that goes back to the other point, which is if they can get better growth, which is I think what Barclays was hinting at, and to some degree Deutsche Bank was hinting at, they get better growth in this marketplace at a reasonable margin, then they're undervalued. And now is a great time to buy HP. And that's what you're really seeing in this marketplace. Unfortunately, if you look at the other kind of big hardware competitor of HP, which is now dumping their server business, this is going to start to change for IBM, but IBM is getting much faster growth at a lower ROIC, which has been hurting. It's helped their multiples. They're getting faster growth, but at a slightly lower. Sorry, where's their price to book? 1.06. Then HP is a lower peg, but it's really the faster growth at IBM that is helping them. And so that's the point. What IBM is essentially done is they have gotten rid of their low growth hardware business, and they're getting all of that growth in the service sector. And so that growth at a reasonable rate of return is really what's giving IBM the multiples. So there is an argument at HP that if they can at least stabilize their loss of market share and loss of PC business, then that service growth at a reasonable return, if it can get to a higher rate, could give them a little bit better multiple. So I guess what I'm saying is the analysts seem to be questioning this level of growth. So that could lead to a buy. But before we place our scenario bets, what was the kind of consensus of the group here? Did you guys think HP was more of a buy, a hold, a sell? What were your thoughts as you guys were building this out?
I'm gonna probably be in the minority, but I said sell. I figured the only way they can be a hold or a buy is if they transform their consumer business and continue to improve their IT business.
So you think that the scenario is even worse than what you described earlier when you were doing the hold scenario?
Yeah, but I might
Or
just
the
be
other?
pessimistic because I just feel like when people think of HP, you're thinking of consumer business and they're not really doing anything. So unless they come up with like a new hit product or something that can combat like the Samsungs and Apples, yeah, I really thought it would be a sell.
Okay. What else did the group feel about
See,
HP?
this is actually one.
Go ahead.
I went ahead and listed this as a buy. A few years ago, they had the whole issue with their CEO and some bad strategy going forward, and they kind of hurt the business a lot. Especially in those years where it dropped significantly in revenue. And since then, they've kind of stopped the bleeding a little bit and kind of started to increase a little bit some of the revenues. And I'm not saying that they're going to start to turn it completely around and have huge revenues going forward. I put them as a 0.5% going forward in growth for the revenues. But I still think the market's being a little too pessimistic on them, and it's undervalued right now. So with my final valuation, I had it trading around the 40s. What it should be is around the 40s as a conservative kind of valuation. Mm-hmm. And so, if they really knock it out of the park, I could see them going up into the 50s. So,
well, when you said 40s, let's do a quick sanity check here. What was different about these ratios? Primarily, was it the margin or the growth rate? We look in the future. This or this? Did you have higher margins? EBITDA? Or just faster growth here?
Yeah, hold on. I had to unmute my mic again. Or just faster growth here. So I went ahead and put the growth at 2% from 2007 or 2017, I believe, going forward. Kept it at that constant rate, and I didn't have the margins going that low. I think I had the margins stopping at around 11%. So rather than in 2019 at 10.7, I think I just had that at 11% going all the way out.
All right. And if I go back to my CVG, 2% as well, then that's where you're getting into the high 40s. Now, what's interesting is if we even look at the ROIC chart, we're still seeing that is a lower ROIC than what we've seen in the historical part. So even if we look at the future, which 47 could be argued as a high price, it's not out of the bounds of reality because we're looking at a potential 15% ROIC down from the high teens. So this still shows a decline. And what it really just says is that, again, I'll go back to where the market consensus seems to be, is that the market consensus seems to be how much of a decline is HP going to be experiencing. So it's not a question of is HP experiencing some toughness in the future. It's really just a point of view on how tough the situation is going to continue to get for them. And, part of it is also whether or not they get a new leader, because right now it seems like their current CEO has been stabilizing the firm, but she has not really, at least in the market's eyes, positioned them for growth platforms. But the flip side is the stabilization probably has put a floor on it. So I know Joel's very pessimistic on HP, which suggests continued decline, and that could happen. But I think what most of the analysts are probably saying is the downside has already been achieved, and the stock price probably reflects more of the downside than the upside. And so I guess that would be the question, which is, where do we fall in? And I think you could make a buy or a sell, a buy or a hold for the most part on HP based on that. By the way, did anybody else have a hold? I know we have a sell option and a buy. Did somebody believe hold for HP? No hold.
Professor, I didn't have a hold. I actually had a sell.
Oh, you had a sell. Okay.
With Joel.
All right.
Yeah, and I think the part that jumped out to me is maybe most telling was in some of the Hoover's research was that their concentration in the product side is much higher than their other, I guess, two peers. So I kind of poked around the same information for Apple and IBM, and I think they're at 65% still in kind of just traditional hardware and computing.
Yep.
Whereas the others are somewhere in the 20 to 15% range. So they've already unraveled and transformed, and HP is very far behind. So I was much more pessimistic on the outlook. And because of the transformation in the out years, it would deteriorate margins even further. So it feels as if they're stabilizing, but they're still 5 years behind others. So I was much more pessimistic on it. And yeah, sure, if they transform, but they have a long way to go. So I had a sell recommendation.
Okay. So again, I think what you're both highlighting is that the challenge of their hardware, and as Joel mentioned, the consumer hardware business in particular, that they have not done very well, as has, for example, Samsung or Apple, but both of them transformed their consumer hardware business by basically getting into mobility, and HP, to some degree, abandoned mobility. Because they bought, who did they buy a couple years ago? Was it WebOS? And then they just basically shut it down?
Yeah, it's not just the consumer piece, though, too. I mean, I think it's just the general diversification. So, I mean, there's, for instance, Apple could be across 5 or 6 different product and service lines, IBM about the same, and HP is in about 2 or 3. Mobility is a very limited piece. Enterprise platforms is another limited piece.
Okay.
So diversification is definitely not there yet.
Okay. All right. So we have 2 sells. So I'll go back to my original question. Was anybody a hold? It's willing to kind of share their point of view on the hold? All right. Well, we'll assume that we have some buys and some sells. By the way, if we go back to the multiples, interestingly, if we look at Apple's multiples, as astronomical as their stock price has been, and even after their 7-for-1 stock split, they're now, what are they trading at, about $100 a share, something like that, which probably puts their market cap close to $700 billion. But what's interesting is their multiples aren't as high as you might expect, which is they're only trading at about 7 times forward EBITDA and about 8 times forward EBIT and a PE of about 14. So interestingly, when we look at Apple, what can we say about their expected ROIC compared to this industry average group of peers?
That should be in line with industry average.
Yeah, so basically higher growth, about average ROIC, and that's really what's giving them these multiples, which are about, well, a little bit higher here, but a little bit below here on a multiple side. So interestingly, despite Apple's great performance, I think what the market is probably saying is that they are probably maturing, and as a result, they're probably going to be maturing at a little bit lower return than what they have been getting historically. So, despite their blowout numbers, they're really not going to maintain growing much faster than the industry, going slightly faster, and that they're probably seeing ROIC is much closer to the industry average. So that is putting their valuations more under pressure. So it doesn't mean Apple can't become more valuable by absolutely growing their earnings, but their days of having much higher multiples than their peers are starting to come down. What can we say about a company like, let's pick another one here. How about Sapient? Actually, how about Xerox? What can we say about Xerox, another traditional hardware vendor, and their multiples? Is Xerox trading at a premium or a discount to the industry? That would be this one. Premium or discount?
It looks like they're trading at a very, mostly a discount, although their enterprise value to estimated EBIT is a little bit higher.
Yes. But I would say, given that the other three ratios, sales, EBITDA, and PE, are lower, and also their price to book is lower, then I would say, despite the outlier there, they probably are trading at a discount. Why?
I think given their PEG and their price book, it looks like their return, their ROIC is probably a bit lower.
Yeah, so at or below industry average ROIC and below average growth. So they're also in that sort of below category. And I think that's why you're seeing generally Xerox trading at a little bit of a discount. So who do you think has the higher expected ROIC? Xerox or HP?
Looks like HP.
So really,
Using price
go ahead.
book as a proxy.
Yeah, if we use price to books and to some degree PEG as a proxy, then it's probably HP has a slightly higher ROIC. So again, it really goes back to HP's biggest challenge is growth and their lack thereof and the lack of expected growth, which again suggests back to if we use the multiples approach to valuation to kind of triangulate our buy sell holds, it's really that lack of growth which we have put into our model in either case that is holding back on their valuation. So to be honest with you, I think the key to unlocking HP's value, if I were thinking about HP, is monitoring what they're doing, not just with their consumer hardware business, but where they're getting growth in the future. And right now, the market isn't really seeing any growth engines from HP, true growth engines. So if that were to change, then obviously there's upside in HP. If that doesn't change, then either HP is fairly priced, and obviously if their core business continues to slip and they don't do anything about it, then you get into the sell category. And the reason I mention this is that next week, when you're talking about Merck and Pfizer, we almost want to make sure that these sections of our valuation are not independent of each other. Because to some degree, the multiples and the cash flow valuation are looking at the same company. And so they should be inferring information to each other. And I guess that's the point I wanted to bring up here, is that what we're talking about with the lack of growth when we did the as is valuation of HP is showing up in the multiples as well. And we could essentially say similar things in both sections. Same thing with the challenges of their declining ROIC, to say that their ROIC is probably closer to an industry average ROIC is also starting to show up in what we're putting into our valuations based even on that future ROIC chart. So again, as you're going through these sections, just wanted to point out that we can consider this to not necessarily be independent. And the other thing I wanted to highlight today was going back to IBIS, that as you guys are working on your reports, to feel free to use the analyst reports to help you out. Particularly what I would say is look for, if you go back in the company research, look for some of the bigger firms. So I don't know who Indigo Equity Research is, so you may not use that if it's on here, but Wells Fargo Securities, obviously JP Morgan, UBS, Morgan Stanley, and the more recent ones, they could actually give you some pretty good insight as well as to help you with your valuations, with your as is, with your buy sell holds. And again, there's nothing wrong with using this data, because since we're doing real companies and using real information, you're perfectly okay, as long as you reference it, with using the data with these other companies. All right. So I'm just going to say that regardless of whether you said buy, hold, or sell, as long as you establish a point of view that is reasonable, then I would give you credit for that part on the assignment and that part for the project. Because even despite my coming up with the buy scenario for HP, it's not saying that we're going to be right, and there is still some uncertainty. So, as a matter of fact, the other thing I like doing is exactly what we've done in this call, which is I almost like playing out both scenarios, because I want to think about the confidence interval and I want to think about the range of uncertainty to reinforce my opinion. I would just say that I'd actually be contrarian to the points of view of the people on this call and say that I actually think that HP might be more in the buy side, because I think that all of the bad news has been priced in. And if they have any sort of reasonable strategy for growth, then there's probably much more upside in their stock than downside. But that being said, they haven't really shown a good inclination for doing that in the last few years, particularly when you take into account their poor track record on acquisitions, which I think is also probably biasing a lot of people in the market against them, at least in the short run. All right, so let's talk about your group projects next week. So what I had put into the announcement section was the group project requirements. So let's talk about next Saturday. So next Saturday, what we're going to primarily do, it'll be a relatively short class for our final class, because technically next Saturday is the exam period anyways, is each of you will basically do approximately a 30-minute PowerPoint presentation, which let's just say it's approximately 20 minutes or so, plus time for Q&A. So there are 4 sections of the PowerPoint, and what would be helpful for me, because I'm going to actually grade you on the PowerPoint while you're presenting, is if you could bring one printed copy of the PowerPoint for me, just so that as you're grading it, then you can I can grade as you go along. And so the way it's going to work is your group project is worth 30 points, and the PowerPoint presentation will be worth 12 of the 30 points, and then the paper will be worth 18 of the 30 points. So there are 4 sections of the PowerPoint. Each section will be worth 3 points. 4 times 3 is 12. And then for the PowerPoint, and then for the paper, then each section will be worth 18 divided by 4 points per section for the written paper. And so what'll happen is I will on Saturday give you a grade after you do your presentation, and I'll give you feedback on anything that I didn't like about the presentation. And then 1 week from Saturday, the paper will be due. Now they're going to be graded independent of each other, so you have to include all of the information in both. But if you have any deficiencies in the PowerPoint, then you will get a chance to correct them before you turn in the paper. So that's the way that we will handle that. And so going back to what needs to be in the PowerPoint, like I said, let's assume approximately 5 to 6 minutes per section. So in the first section, you're going to talk about EIC. And in EIC, for the PowerPoint, for the paper, there needs to be some very specific screenshots from Bloomberg or other data sources in your paper and in your PowerPoint. So specifically, everyone's going to have the latest LEI and CEI graph from the conference board. So I'll jump here to conference dashboard.org. And if we go to US indicators, if we go to the leading economic index, then if we look at the latest press release, in the latest press release is the latest LEI and CEI through May, and this is the screenshot that everybody would need to have. So there's your economic data suggesting good times for the future, despite the GDP problem in the first quarter of this year. And essentially, you want to talk about the economy. You can bring in any other macro data that you want. And then the other screenshot that you'll need is you'll need your company's beta. So again, you're going to need a 5-year beta. So if I go to beta for HP, then change this to 09, hit enter, and this would be the 5-year beta. And then you're talking about whether or not your company is more or less sensitive to the economy. So that is the first section of the E and the EIC. Next, 5 forces. So as part of the 5 forces, you're going to need to have the 5 forces table, which has each of the forces scored 1 to 5. and the overall 1 to 5 based on the industry spread. The other thing you're going to need is the ROIC and WACC for your industry to support the 5 forces overall for the current. So again, if I go back to Bloomberg on the RV screen, you're going to need the screenshot with the spread, which had the industry ROIC against, I'm just using HP as an example here, with the market cap weighted average. So there's the industry ROIC, industry WACC. So that should support your 5 forces for the current, and then you need to basically put in the 5 forces table, and then you'll be discussing why you scored the 5 forces, what you did today, and why you think they're going to change, if you do think they're going to change, over a 5-year point of time. In the C part of the EIC, you need to talk about competitive advantage. So in this case, given this data, just look at HP real quick. Does HP have a competitive advantage? I assume I'm still sharing my screen. So what can we say? Does HP have a competitive advantage?
Yes, looking at the spread, they're slightly higher than the industry average spread.
That's right. So that's what's going to be key to say about Merck and Pfizer. So again, referring back to the RV screenshot. For the historical analysis, you're going to go through the tree, which is this tree. Again, make sure you cover both sections of the tree, meaning tax rate, operating margin, productivity, and drivers of operating margin, drivers of productivity. And then you also must do the CFI. Again, in your model, you may have to hide, don't delete because it'll wipe out your valuation, but you may need to hide most problems. The forecast years, so you got the total right next to it. Basically, this is the screen. Go through all 4 sections, talking about the overall reinvestment rate, what's happening with the non-operating cash flows, what's happening with the debt and equity cash flows. Then you'll need to go through the multiples. What I'd really like to see is to keep it simple, you can actually just limit yourself to 6 peers in your analysis, but you have to have a minimum of 6 peers. So for example, with HP, you could have the whole list that we just had, but ideally I want you to focus on the largest 6, and I want you to rank them. So I want you to talk about whether your company is trading at a premium or discount, and I want you to rank the relative ROICs for at least the top 6 peers from highest to lowest. So, and if you have to, you could say, well, I think at least these 2 are higher or lower. If you can't see, give me the exact ranking, but just give me a relative ranking. So start out by thinking about who's in the top 3, who's in the bottom 3 based on expected ROIC, and then including your company in those, and then basically try and do a relative ranking 1 through 6 of highest to lowest based on expected ROIC that explains the multiples. And then finally, in the valuation section, you're going to do an as-is valuation. You're going to give me your assumptions. You're going to do the final valuation. You're going to give me your delta assumptions, your buy, sell, hold, and then you'll support everything with the final, the ROIC chart. So make sure you include the ROIC chart. So that's really what we're going to be going through in the PowerPoint of the class, and that's what you're going to have to include in the paper. So again, assume they're going to be graded independent of each other. So if you present it in class in the PowerPoint, but you don't talk about it in the paper, or you don't have the graph in the paper, then I'm going to assume that it's not there. So you have to put it in both. So just 2 different ways of presenting the same data. And again, I want everyone to participate in the presentation. So that's what I'm looking for next week. Questions about that? Any questions about the project? All right, I'll take that as a no. So what we'll do then is after we listen to the PowerPoints, we will wrap up, cover a couple more key points, and then I'll make the final exam available. So what will happen is on the 19th, you'll do your 2 presentations. You'll have 1 week to complete the final exam. It'll be due on the 26th electronically in Canvas. It's a take home, just like the midterm. Won't have a timer associated with it other than the 7 days. And you'll have 1 week to turn in your written paper. So the paper will be due on the 26th. The final exam will be due on the 26th. You'll submit both of those electronically via Canvas. And then my other request is that next week you also upload a copy of your PowerPoint to Canvas as well. All right. So that is our plan. And unless there's any other questions, we'll just make this a relatively short class and give you time this morning to work together to get your data on your group projects. All set. Questions? All right, I'll take that as a no. So again, email me with any questions you have on your group project. Otherwise, we'll see everybody next Saturday morning at the Reagan building, ready to present. Have a good weekend.
Right.